Hello all, welcome back to Think, Explore, Learn. Today we are going to summarize the 2020 best-selling book, The Psychology of Money by American finance expert Morgan Housel. This book isn't about how to play the market, stock pick, or get rich quick. Instead, it gets the reader to closely consider how they think about money and how they behave with it. According to Housel, people who do not have a formal financial education can still succeed financially by learning the psychology of money. The book is divided into 20 chapters, and the author ends each chapter with a recommendation to the reader. So let's look at the lessons from each chapter. In Chapter 1, No One's Crazy, Housel discusses how individuals' backgrounds and childhood experiences influence their perception of money, risk, and financial management. To illustrate this idea, he contrasts the experiences of the average American during the Great Depression with that of President J.F. Kennedy, who grew up wealthy in the 1930s. When John F. Kennedy ran for president in 1960, he was asked about his experience of the Great Depression. His answer surprised many voters. The Kennedys, he said, were already wealthy in 1929, and over the next 10 years, their fortune wasn't wiped out, it actually grew. By 1939, the family had more servants and lived in a bigger house than it had at the start of the decade. It was only when he went to Harvard and read about the Depression and realized how badly many of his fellow citizens had suffered. In Chapter 2, Luck and Risk, Housel argues that both luck and risk play a significant role in individuals' financial journeys. Housel believes that people often overlook the role they play in success and failure, as there is too much focus on personal decisions and efforts. He shares the story of a man who was an excellent investor but suffered huge losses when his investments were wiped out by a natural disaster. Housel argues that this is an example of how luck and risk play a huge role in financial success and failure, and that we should be mindful of this when making decisions. In Chapter 3, Never Enough, Housel recommends that individuals carefully consider their needs and desires and keep their ambition in check. The chapter discusses how many financially successful people cannot appreciate their wealth as they envy those who are wealthier and constantly seek to accumulate more wealth and possessions. Chapter 4, Confounding Compounding, highlights the importance of compounding in individuals' financial success. The chapter emphasizes that individuals benefit most from compounding when making long-term deposits or investments. The chapter uses Warren Buffett, who began investing at age 10 and was able to amass a fortune through the power of compounding, as an example of how long-term compounding can yield amazing results. Chapter 5, Getting Wealthy versus Staying Wealthy, argues that individuals focus too much on attaining wealth and seldom consider the best ways to stay wealthy. The chapter recommends maintaining a barbell approach to finance, being optimistic and somewhat risk-taking to attain wealth, while remaining wary, frugal, and fearful to keep it. Chapter 6, Tails, You Win, examines the role of tails in stories of extreme financial success, such as Walt Disney. Housel defines a tail as a very rare occurrence, again emphasizing the role of luck or chance in finance. The chapter uses this analysis to remind readers not to focus on the success stories of specific individuals, but to try to emulate more general patterns of moderate success. Chapter 7, Freedom, argues that freedom and a sense of control over one's life are the best things that money can buy. The chapter cites research that shows people who feel in control of their lives tend to be much happier than those who lack freedom and independence. The chapter uses this observation to support its argument that saving for the future should be a top priority for people of all income levels. Chapter 8, The Man in the Car Paradox, explains that when people see someone driving an expensive car, they imagine themselves driving it, rather than admiring the driver. The chapter urges readers not to waste money on status symbols like cars, clothes, or jewelry as a way to earn admiration from others. In short, no one is as impressed by your stuff like your house, car, etc. as you are. In Chapter 9, Wealth is What You Don't See, Housel emphasizes the importance of frugality and savings over excessive spending. The author notes that it takes discipline and restraint to become wealthy, and that accumulating material possessions is not the key to happiness or financial success. He argues that by focusing on long-term savings and investment, individuals can build the financial security and freedom they need to pursue their goals and live a fulfilling life. Chapter 10: Save Money Like a Pessimist, Invest Money Like an Optimist, makes the case for consistent savings as the key to long-term wealth building. The chapter argues that saving money is even more important for long-term wealth building than having a high income. The chapter encourages readers to embrace the benefits of long-term compounding by consistently saving their money. In Chapter 11, The Reasonable versus the Rational, Housel contrasts reasonable and rational approaches to financial management. He argues that while finances can be analyzed rationally, it is more realistic for most people to aim for a reasonable approach. For example, a rational retirement savings strategy might depend on borrowed money that would be very likely to increase in the long term. But it is unreasonable to expect people to be comfortable with that degree of risk, even if it is rational on paper. Chapter 12, Surprise, reminds readers that there will always be negative events that cannot be predicted or planned for. Housel uses history's financial downturns to show how conditions can change quickly and unexpectedly. He encourages readers to have a margin for error in their financial plans, as no one can ever be completely certain investments will work as expected. Chapter 13, Room for Error, follows up on this recommendation by encouraging everyone to have a margin for error in their financial plans. No one can be completely sure that investments will work out as planned, so having a backup plan is critical. In Chapter 14, You'll Change, Housel explains that people's interests, professions, and short- and long-term goals change over the course of their lives, often more than they expect. Instead of clinging to the same financial plans made when younger, it is better to keep finances flexible to reflect new goals. Chapter 15, Nothing's Free, gives readers a realistic look at the ups and downs of stock market investing. Housel explains that, like everything else in life, investors pay a price to participate in the system, losing money on poor investments. Housel encourages readers to see losses as fees they pay to participate in the system, as everyone experiences them, and they are inherent to the process of investing. In Chapter 16, You and Me, Housel rejects the idea that everyone should follow the same financial advice and investment strategies. He argues that day traders and people with short-term goals should have a different approach from the average person saving for their long-term plans. He claims that bubbles are a natural result of market trading, only becoming damaging when long-term traders with one set of goals begin imitating day traders who plan to sell their stocks within short time frames. Chapter 17, The Seduction of Pessimism, warns readers against pessimism. Housel notes that in spite of various financial depressions and recessions, the stock market has increased 17,000-fold in the last century. Housel believes humans are biased to pay more attention to negative events, and unfortunate events tend to happen quickly while beneficial growth happens over a long period of time. Chapter 18, When You'll Believe Anything, expands on people's biases in financial decision-making. Housel warns readers against becoming overconfident, as no one knows what they do not know, and everyone is operating with incomplete information. He also observes that people tend to favor analyses that they want to be true, which can lead to flawed decision-making. In Chapter 19, All Together Now, Housel reviews the tips covered in the book thus far. He follows this with Confessions, in which he explains his own approach to personal finance. Housel reveals that his number one priority is independence, living a modest lifestyle that is far below his income, saving a great deal of his money to ensure he will have the freedom to make his own personal and professional choices. He also keeps a large amount of cash available to him, so he does not have to worry about being unable to cover an unexpected expense. He shares that it is important to him to not have to sell stocks in order to deal with an emergency, since he wants the profits to compound for as long as possible. Finally, Chapter 20, Confusion, examines the worldview of the average American consumer through a historical lens. Housel notes that modern Americans tend to be too comfortable with debt, and there can be painful consequences to living beyond one's means, which has become normalized in American society. He reveals how people's expectations about their finances have changed since World War II, focusing on how people are borrowing more to fund more lavish lifestyles. He advises, live below your means and save and invest that money every month. Put simply, in The Psychology of Money, Housel offers a unique perspective on personal finance. The top 5 nuggets of wisdom I took away from this book are: the ability to control your time is the biggest dividend you get from money and wealth. Live below your means and save/invest that money every month, every chance you get. No one is as impressed by your stuff, that is your house, car, etc., as you are. Keep a buffer for contingencies and the unexpected events so that you don't have to dip into your investments, which lets them keep compounding. And lastly, compound interest is the most powerful force in the universe. Hope you got some valuable knowledge out of this book summary. If you did, please give this video a like and share it with anyone you know would benefit from this info. Thank you for watching.